Welcome to Pride Partners International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Thank you, everybody, for joining this webinar today on the developments in the Netherlands on transfer pricing issues. My name is Jimmy van der Zaan. I'm partner at Taxand in the Netherlands, involved in transfer pricing. Of course, I'm heading the transfer pricing practice, and I will be presenting today with Thomas Dijksman. He first joined the Dutch tax authorities for 4 to 5 years, after which he joined us with Taxand in the Netherlands. Thomas, would you explain to us on what we will be presenting for the next 30 to 40 minutes today?
Yes, Jimmy, and thanks for the introduction. The reason for having this presentation is new Dutch legislation on transfer pricing area, especially to target mismatches. And we will present the broader developments in the transfer pricing area as well, amongst which an updated Dutch ruling policy, the implementation of the two-sided approach in Dutch DP practice, and then we will get to the new legislation with some examples. And afterwards, we will also touch upon other relevant developments, such as the conditional withholding tax on interest and royalties and increased substance requirements.
Yeah, thank you, Thomas. And perhaps good to mention for everybody that we will be open for any questions after our presentation. So please send any questions you may have via the message function in Teams, so that we can address those questions afterwards. But first, let's do a little step back. So why are these new rules triggered in the Netherlands? And it's obviously that there's a more coordinated approach internationally nowadays to target tax avoidance. And of course, the Netherlands has always been perceived to be a tax haven, and nowadays wants to be a kind of a front runner in the avoidance of tax evasion. And this international approach already started with, of course, BEPS, but also ATAT 1, 2, and 3 upcoming, and pillars 1 and 2. And in all these new rules, there is a flavor of the anti-tax avoidance. And the approach taken by the Netherlands is that they want to follow the international rules. They want to be a step ahead of the rest of the world, but at the same time, they do not take actions which are not supported by either the EU or the OECD, which sometimes always also slows down the process. You can find these actions from the Netherlands in the Dutch transfer pricing decree, which is a decree which is updated from time to time, more or less following the Dutch transfer, the OECD transfer pricing guideline, but also including some viewpoints specifically from the Netherlands. Also, the ruling practice has been amended, in which we can find signs of the wish to avoid tax avoidance, and we will hop on that later on during this presentation. And of course, there is the new legislation to target TP mismatches, which is the trigger of today's presentation, but also in the related topic, you will find the similar find. So it's a broader perspective, all focused on the avoidance of tax evasion, which is included in, well, most Dutch proposed legislation nowadays. But perhaps it's good to first start with the APA regime in the Netherlands. Thomas, can you be so kind?
Yes, indeed. The APA decree has been updated in as per mid 2019, and then they introduced some new thresholds or requirements to request a ruling. One of them, which is very important, is the economic nexus. We will present some examples in the presentation, but the key issue there is that operational business activities related to certain transactions are required in the Netherlands. So you cannot interpose the Netherlands in a transaction just on paper. Also, what has also been introduced is the anonymous publication of rulings. This is because the media wrote about rulings in a sense that it were some kind of gifts by the state, which is explicitly not the intention. So with the publication, the Netherlands wants to present that it's just following TP guidelines, and that there are no strange agreements with the taxpayers in place. And then the ruling, the decree also pointed out clear that rulings will not be concluded when the sole purpose or the main purpose of entering into the ruling is obtaining a tax benefit. So that's stressed in the new decree, and also transactions with low tax or non-cooperative jurisdictions will no longer be concluded.
Yeah, perhaps Thomas, it's good to mention that the economic nexus in this perspective is something different than the substance requirements. In the Netherlands, the substance requirements were already proposed many years ago, stating in brief that at least the majority of the directors of a company should be Dutch resident, and preferable that you also have some kind of office space available. But this is insufficient for the new ruling practice. So economic nexus is really, as you mentioned, business operations, which is beyond just having the majority of the directors being Dutch resident. If we now move on to the first example, this is a clear example in which no ruling will be granted. It's a Dutch company, which is a distribution center. It receives a loan and a license from a parent company abroad, and sub-licenses this license to affiliates in the Netherlands. Obviously, a distribution center does not have any active involvement with licensing or providing loans. It's really a different type of business, and if that's the case, then it will be very difficult for the Dutch tax authorities to enter into a ruling. At the same time, this does not mean that the general transfer pricing principles do not apply. So it's still possible to grant the ruling, to grant the license and determine an arm's length pricing, but it will not be possible to obtain an advance pricing agreement on this with the Dutch tax authorities.
Yeah, and on the other area of the spectrum, there's an example where the other facts of the case being similar, or at least the transactions being similar, with a Dutch company with 100 FTE of employees involved in exploitation of rights that relate to the license agreements. And in such a case, the Dutch authorities would be happy to enter into a ruling because the economic nexus criterion is fulfilled. And it's good to mention that the economic nexus criterion is a new definition which should develop over time in practice. So we just explained on the on a few clear cases, but there can be some gray areas.
Yeah, and perhaps interesting to add that we are currently working on a bond issue, and it's more or less similar situation as the chart on this slide. So it's a foreign headquarter with a financing with a subsidiary in the Netherlands also performing a financing function, and then the Dutch tax authorities are looking to compare the number of people in the Netherlands with the people in the headquarters. And from a Dutch perspective, it's extremely logical if the Dutch subsidiary would be involved in the bond issue. They have like a couple of people working in the finance and treasury team. But if you compare the number of people in the Netherlands with the people in the headquarters, it's obviously there are more people involved in financing and treasury in the headquarters. And that's also an indication which the Dutch tax authorities will look into, because if it's too much out of balance, then at the same time you will not be granted a ruling. So it's the overall picture which is relevant for the tax authorities, not just the people in the Netherlands, but also the people abroad performing a similar function.
And then on to the anonymous publication. It's good to mention, since this is we've got already 1.5 years experience with this, that the publication is indeed anonymous, and that it's not possible for the media to digest the companies that are involved in the rulings. And also the information that's published does not include the final pricing whereupon agreement has been reached. So it's just the upper quartile and the lower quartile of the range in case of a TNMM ruling. So it's just a high level indication of the facts and circumstances and the agreement that has been concluded. And also good to mention is that in practice no rulings have been concluded until now on arm's length interest rates. So of course loans are frequently granted within MNEs, but on interest rates no rulings have yet been concluded.
Yes, and perhaps also interesting to mention, in addition to which information will be open for publication, that's typically how Dutch tax authorities work. So they have an open relationship with the tax lawyers. So there's an exchange of and there's communication between the tax authorities and the taxpayer and their advisors. to agree on which information will and will not be published. So it's up to the taxpayer for a great extent to indicate which information could be tracked down to their position, which then of course will not be shared publicly, because they will do anything to prevent that it becomes clear which taxpayer did obtain the ruling. So any facts and circumstances leading to a specific taxpayer will not be included in the publication.
And then on to the jurisdictions that are on the Dutch list of non-cooperative or low-taxed jurisdictions. The Dutch list, in fact, mirrors the EU list, but also adds countries that have a corporate income tax rate of lower than 9%. The jurisdictions are listed on the slide. Maybe not. There are some jurisdictions that are perceived as tax havens, but maybe not all. But in any case, it's not possible in the Netherlands to request a ruling on a transaction with a jurisdiction that is listed on the Dutch list.
Yeah, shall I take this one, Thomas? The two-sided approach, of course, is a very interesting development, which nowadays is being supported by the Netherlands. But in the past, the Dutch tax authorities did not so much follow the two-sided approach. So, for example, if a parent company abroad would contribute goodwill, technology, a part of the business client list to its Dutch subsidiaries, the Dutch tax authorities were just keen on understanding the Dutch position of that part of the transaction. So in many cases, that would be the case. So in many cases, it would mean a step up in value at the level of the Dutch subsidiary, which value, of course, could be depreciated over time. And the Dutch tax authorities were not so much interested in whether or not there was a taxable gain in the other jurisdiction. That, of course, changed dramatically, also due to the implementation, of course, of the master file and local file, for which reason there is more information available. Also, the OECD is stressing more and more that the two-sided approach should be taken into account, but that's really a thing which is relatively recent in the Netherlands. So it's over the last few years that this approach has been taken by the tax authorities, and that's also the reason for this presentation today, because the Dutch tax authorities is now even going a step further and also propose a change to avoid TP mismatches, and that's really the two-sided approach next level.
Yeah, and then to the final proposal, which by the way is now with the Dutch Senate and is expected to be finalized just before year end. The Dutch Senate will just do a technical review, and we do not expect that this will have any effect on the implementation, given that it's quite straightforward. The legislation aims at additional deductions based on the arm's length principle in the Netherlands, be it through costs or depreciation, and thus it's about text to book differences, the check that has to be made is whether in the foreign country the same adjustment will be made. And thus whether there is a corresponding upward adjustment that corresponds to the Dutch downward adjustment. In the Netherlands, the OECD TP guidelines are generally followed, but in addition, there is the Dutch TP decree, which provides more guidance in areas where the guidelines leave room for interpretation. So this is what the legislation aims to target, where the interpretation of the arm's length principle is different between countries, and where part of profits is not taxed as a conclusion thereof. We will now get to the first example.
Yes, and this I think is an extremely clear example. And in brief, the legislation that proposes to deny a deduction in the Netherlands if there's no pickup of the same amount abroad. In the Netherlands, based on case law, it was always possible that if you have a loan agreement between a foreign company and a Dutch company with, for example, a zero rate interest, then from commercial purposes, the zero rate would be taken into account, but based on case law, you would be allowed to deduct the 5%. And that will change dramatically by this new legislation, because in the future, this 5% will no longer be deductible in the Netherlands if it's not being taxed abroad. And that's a clear sign. And the rule is that it should be included in the taxable base. So in principle, the tax rate is irrelevant. So even if you pay an interest to a country in which you only pay 9% or 10%, that would be still fine for the Dutch tax authorities, even though that the deduction would be claimed in the Netherlands against the standard statutory corporate income tax rate of 25%. So it's sufficient if it's included in the taxable base. If it's excluded due to a exemption, then again the rule kicks in. But I discussed this topic with Thomas earlier. That will be seldom the case, so we will not spend any more time on this example.
And then the second example is also where we talked about already, that the Dutch company acquires an asset, let's say an intangible asset, and in our example, the acquisition price would be 100, while based on a valuation report, the arm's length price is concluded to be 200. Then in the current legislative framework, you would book the asset in the textbooks for an amount of 200 and depreciate accordingly. But with the new legislation, you have to look at the tax treatment of the in the exit jurisdiction, because when a price of 100 is in the contract, it may well be the case that 100 is reported as income in the exit jurisdiction. So with the new legislation, the Netherlands may only book 200 in accordance with the arm's length principle if the exit jurisdictions also taxes 200.
Yeah, and that means that these type of structures will only be used in cases where, for example, the foreign company has a loss carry forward available to absorb these profits. It's also good to mention, I think, that if a correction takes place afterwards, or an adjustment, so that in principle first, in our case, ACO would book 100, and 2 or 3 years after 200 as a taxable profit, then in principle the Dutch tax authorities should also allow an adjustment in the Netherlands. Although the wording in the proposal is fairly interesting, because they indicate that profits should be at least taxed once, meaning at least. So that is indicating that they at least threat or allow a double taxation, and that of course should never be the case. So there will be some flexibility from the tax authorities to make amendments into the future, but it will not in all cases be easy to claim such an avoidance of double taxation. But how this will evolve, of course, needs to be seen. Perhaps also another thing which is interesting to mention, I'm not sure, Thomas, whether you read, this will also apply to transactions that took place as of the mid of 2019, which are still under depreciation upon implementation of this new legislation. And that's of course a difficulty for taxpayers and bringing some insecurity. And that's also a thing which was put forward by the Association of Tax Advisors, that should not be the case when new legislation is implemented. But the government feels sufficient comfort in maintaining this in the proposal. So it has some retroactive effect, which normally should, of course, not be the case with new legislation.
Yes, indeed, and yeah, unfortunately, that is something taxpayers have to deal with. Regarding the documentation part and the burden of proof, there are two tick the box positions in the tax return. One was already there, was whether a Dutch company reported an informal capital contribution, or in other words, whether it would deduct additional expenses compared to the commercial transactions. And two is whether the corresponding income is included in the foreign jurisdiction. And the documentation, the proof that this is indeed the case, should be kept by the taxpayer itself, and there's no need to file it other than upon request of the tax authorities. So, and burden of proof is free of form. So yeah, in practice, it has been highlighted that can lead to difficulties. For instance, the language can make it difficult to explain, or the way the local income tax system has been set up. Yeah, it can be difficult to actually prove that that income is indeed included.
And at the same time, it's of course to the tax inspector to allow evidence. So the form of evidence is free. So the taxpayer is free to provide any evidence it has at hand. But whether it's sufficient is to be determined by the tax authority. And of course, if you do not get an agreement on that, you will have to go to court. So it also leads to uncertainty on this part. And as mentioned, we would also, that's then the next slide, we also briefly mention some other topics from which you can see that the Netherlands do not want to be the perceived tax haven anymore. This conditional withholding tax is the whole mention that is implemented and will be further implemented in 2024. This legislation relates to withholding taxes on interest and royalty payments. Until this legislation, the Netherlands did not have any withholding tax on interest and royalties, but it will have a withholding tax if you pay interest and royalties to low tax jurisdictions, and that's because the Netherlands do want to avoid that the Netherlands is used as a pass-through jurisdiction, and the withholding tax then is levied at the corporate income tax rate of 25.8%. So it's a fairly severe impact.
Indeed, and the idea is that such structures will no longer be in place because of the severe levy on the payments. So, and in this way, the Netherlands avoids that it's that it's part of structures where royalties flow to these tax havens, and that's obviously good for the Dutch government, since they do not want to since they find it difficult to explain that the Netherlands is or has been sometimes a crucial chain in these kind of structures.
And at the same time, the impact of this legislation will, of course, reduce after the implementation of Pillar 2, because due to Pillar 2, likely many jurisdictions will set their minimum tax rate at 15%, which is above the threshold, which is including in this legislation. So likely over time, we will no longer have a withholding tax on royalty interest anymore, but for the time being, it's a thing to take into account.
And then another topic that is also kind of related are the substance requirements. Jimmy, you already mentioned the requirements in the beginning of the presentation. This is a specific list of requirements for Dutch entities that render financial services within a group. So either lending money or entering into IP or lease transactions, and those entities had a minimum requirement for the local presence in the Netherlands, and this has been increased with a minimum payroll of 100,000 euros and an office space in the Netherlands from which the work is performed, with a lease of at least 24 months. So this also affects the landscape, and if a financial entity in the Netherlands does not meet the requirements, the Netherlands will exchange information with the source countries, so they may decide to levy withholding tax on this basis.
Yeah, so there are all measures to show to the international community that the Netherlands is not so much supportive anymore of the flow-through entities. And the last rule, but that's still under proposal phase, is that back-to-back intra-group transactions had a kind of a safe harbor. So these companies should have an equity at risk of 1% of the loan volume or 2 million, for which reason it was extremely attractive to do the back-to-back transactions via the Netherlands for big volumes. But likely this will be abolished, but we were working on that already. So we were preparing benchmarks to demonstrate how big the equity at risk for these type of financial transactions should be. But it's another sign to show that the Netherlands do no longer want to be perceived as a tax haven, and that's, I think, also one of the takeaways of this presentation. The Netherlands no longer wish to be a pass-through country, so they are a bit more strict on their transfer pricing rules. The two-sided approach is really a thing to take into account for transfer pricing purposes. It will no longer be possible to use it in mismatches due to the proposed legislation. At the same time, we feel that the Netherlands is still an attractive jurisdiction for the reason that we have a very good participation exemption and a very transparent and communicative tax authorities, which still make the Netherlands worthwhile to be used or implemented in a tax structuring, but the tax authorities is getting clearer that they do not want to support tax avoidance. So I think with that we are with the end of this presentation. Many thanks for listening to us, and please let us know if you have any questions, and if you are not having any question at this moment, please feel free to drop us an email or give us a quick call. Thomas, many thanks for co-presenting this presentation.
Thanks, Jimmy. Bye.